We'll wait another minute or two, see what kind of attendance we drew out today. If nobody shows up, I'll do the lecture. Hi, Brendan.
Hi, how are you?
How you doing?
Good, how are you?
I will wait another minute or so, okay, and see if we get any classmates.
All right.
No problems with chapter 1, I would think, huh, Brendan?
No, it's pretty straightforward.
Yeah. This today is a key lecture as we get into debits and credits. That's the part that's going to cause a little anxiety for a while till you master them.
All right.
Here we go. Grant is joining us. That's good. How you doing, Grant?
Good, how are you?
Good. Welcome aboard. I'm just trying to adjust this darn camera. Can't seem to. Oh, there's my mug right there. Okay, I guess it's a little after 1 o'clock. We might as well get into our class. And this is a real important chapter as we introduce debits and credits. Debits and credits. And we'll wait to welcome Maria. Hi, Maria.
Hi.
All right, here we go. Can somebody verbally tell me they see the slide?
Yep.
Okay.
Yep.
I think I explained the reason I need that verbal assurance is on a couple of occasions, I've done an entire lecture without the students telling me I never put up the slides. So I look like an idiot. All right, here we go. Accounting for business transactions. And then a couple learning objectives. Explain the steps in processing transactions using source documents. Business transactions and events are the starting points of your financial statements. Process from transactions to financial statements. Identify each transaction and event, probably from a source document. A source document usually means a piece of paper. It could be a lot of different things. A cash register tape. It could be an invoice. It could be a bill. It could be anything, but it drives a transaction. Analyze each transaction and event using our famous accounting equation, assets equal liabilities plus equity. Record the relevant transactions in a journal, and then we post to the ledger. And then after we've posted everything to the general ledger, we're ready to prepare our financial statements. Now, when they talk about analyze each transaction, the analysis could be as simple as you opened up your mail and there is the electric bill. Well, that's a transaction that needs to be recorded. You open up the bill and the bill is $500 electricity. You look at the past couple of months perhaps and see that that's in sync with what you've been paying. And then you finish that analysis and you record it in your general journal and into the general ledger. It could be something much more complicated, analyzing your payroll. how you're going to record the payroll this month. Source documents, what are we talking about? Bills, receipts, checks, purchase orders, payroll records, they're endless. Bank statements. It could be a printout of a text, a printout of an email, instructions from your boss. You know, he might say, Maria, make sure you record these transactions, and that's your source document. Now we're going to talk about, now we're going to get into the guts of the recording. We're going to describe an account and its use. An account. An account is a record of increases and decreases in a specific asset, liability, equity, revenue, or expense. An account. Cash is an account. Accounts receivable is an account. Inventory. Accounts payable, notes payable, equity, retained earnings, sales, phone expense, payroll expense. These are all called accounts. Think of them as a folder in your general ledger. And in each of these folders, you're going to record the increases and decreases in that specific account. And that's done into the general ledger. It's a record of all accounts used by the company. So they're just showing you the folder here. Assets. Look at what we got for assets. Wow, look at all those. Everything from cash, receivables, inventory, prepaids, and then to our fixed assets. Liabilities, they have different types. And equity, which is the ownership of the company. Assets equal liabilities plus equity. And here they're just showing more asset accounts. Assets, anything good to own that the company owns that will help them make some money in the future, hopefully. Liability accounts, whenever you see the word payable, you know that that is a liability. Accounts payable, notes payable. Accounts payable is money you owe your normal business associates. Money you owe to the normal people you do business with, your suppliers, right? Notes payable is a borrowing arrangement. You borrowed money and you have to pay back a bank or a lender of some kind. That's notes payable. You'll learn about accrued liabilities. These are liabilities we recognize at the end of the month, even though we don't have any documents yet. And unearned revenue, where we receive money in advance but haven't earned that money. So we'll continue. Equity. Equity. Assets equals liabilities plus equity. And equity is impacted in 4 areas. Common stock, company issued stock to the public. They brought in revenues. Any revenue increases equity. Any expense decreases it. And dividends decrease the equity. When you give a dividend out in the form of a payment, you are giving away part of the company's ownership. Dividends are not an expense. So we're looking at our expanded accounting equation again. Assets equal liabilities plus equity. And what are the 4 components of equity we've learned so far? Common stock, dividends, retained earnings, revenues, expenses. Common stock goes up, dividends goes down, revenues up, expenses down, huh? If I'm going too fast or talking too quickly in my New Jersey pace, jump in there and say, hey, slow down a little bit. Describe a ledger and the chart of accounts. Okay. We said that cash is an account, accounts receivable. All these things you see here, all of your accounts are considered to be part of what's called the chart of accounts. The ledger is a collection of all accounts and their balances for an accounting system. The company's size, diversity, effective number of accounts needed. The chart of accounts is a list of all the accounts, and they always have an identifying number, okay? Some companies have a lot of items in their chart of accounts. Other companies try to keep things simple by combining a few things. For example, most companies have an electricity would be an expense, gas, excuse me, guys, gas, water, sewage, perhaps. Other companies, they do what this company does, they put it all under utilities. So it's up to the company how many accounts they want to establish and thus track. Here we go now. To you people who have not taken 110, you are now going to see something that's going to drive you nuts for a little bit. But you'll get through it. Everybody does, right? Define debits and credits in the double entry accounting system. Debits and credits. A T account represents a ledger account and is used to show the effects of one or more transactions. So what are we talking about here? Think of this T account. You can see the T. Think of this T account as your general ledger. And we're going to debit numbers into it, and we're going to credit. Debit, credit. All it means is left and right. Debit and credit, all it means is left and right. A debit is not better than a credit. Credit is not better than a debit. They have no moral duties attached to them. So here we look at our accounting equation, assets equal liabilities plus equity. Now what are you seeing? You're seeing the rules of the debits and credits. Take a look at assets. Assets have what's called a normal debit balance. A normal debit balance. That means that assets are expected to have more debits than credits. Assets have a normal debit balance. Cash is an asset. You can't have negative cash unless you're playing the float the check game. You can't have negative accounts receivable. So assets have a normal debit balance. The normal balance means the side of the T account that increases the account. So if we're increasing assets, we're going to debit it. If we're decreasing, we're going to credit it. If assets have a normal debit balance, liabilities and equity, thus would have to have a normal credit balance. In other words, liabilities and equity are increased with a credit, increased with a credit, decreased with a debit. So these are the rules that are hard and fast. There's all kinds of tricks, acronyms and stuff I could give you if you like to memorize them. But just do the homework in chapter 2 here, and it should get you a long way. If this was 110, we'd be spending a lot of time on this, okay? And then here we go. Here's a look at the accounting equation again, with shown in T accounts. Assets, normal balance, debit, liabilities and common stock, normal balance credit, revenues, normal balance credit, expenses, normal balance debit, dividends, normal balance dividends. Again, the normal balance means the side of the T account, left or right, debit or credit, which increases the balance. Okay? And you just have to memorize these. That's all there is to it. It's really not that much, but it's rather counterintuitive and can cause a little bit of anxiety as you get going with the accounting world. An account balance is the difference between the debits and the credits, between the increases and decreases. Look at this account. Look at your general ledger here for cash. What was the activity? Well, they brought in a stock issue, $30,000. They earned some consulting fees, and they brought in some accounts receivable. Some of their customers paid them. These are debits and thus increased the cash. Credit, here is the spending. The spending. They spent money on supplies, equipment, rent, salary, accounts payable, dividend. The total debits equal 36,100. The total credits equals 31,300. We subtract the difference, and that's the balance. Not too tough. Debits minus credits, and the high man wins, right? If the credits were higher, then you'd have a credit balance. Here we're going to talk about using a journal entry to post to the ledger. And what were we saying with transactions? Identify the transaction in the appropriate source documents. For years and years, you always hear about the paperless office. Everything is online, computerized. Yeah, but you still need pieces of paper to support what the heck you're doing. So there'll always be paper flying around. Identify transactions, analyze the transaction, record it, and the vehicle we use to record it into the ledger is called a journal entry. And then once we've written up our journal entries, we hit a button called post on the computer, and psh, it goes into the general ledger, the books of record. So let's see what a journal entry looks like. You'll have a lot of homework in this. Journal entry. You're going to have a date. On the top, you could put the year just on top, but no more than once. A date. You're going to have a debit and a credit. Every accounting transaction must have one debit and one credit. That's why it's called double entry accounting. Okay. So here you see the transaction for $30,000. That was the ownership, they issued stock and raised $30,000. So here they're recording it. You have a debit to cash, credit to common stock. Debit to cash, credit to common stock. They spent money on supplies, if you remember, $2,500. Debit to supplies, that asset goes up with a debit. The cash goes down with a credit. Notice that the debit is listed first. Typically, you want to put the debit first, okay? That's the expectation. It wouldn't be wrong if you did it opposite, but you'd be telling the world that you're inconsiderate, because that's what auditors expect to see when they look in. You debit first, then credit. And very important, you notice the credit is indented. Super important. That breaks up the screen for the auditor and the users of this data to understand it a little bit more quickly. T accounts are useful illustrations, and that's all they are. T account is just a piece of scrap paper. You'll be using T accounts in meetings. You'll be trying to figure out a problem that's going on with the company, and someone said, "Go, let's put it up in T accounts and see what that kicks us." T accounts are useful, but balance column ledger accounts are used in practice. This is a typical general ledger, and you're going to have one folder like this for each account. So here's your cash. On December 1st, they brought in $30,000. That means that's the balance. Then they had two spending events, which brought the balance down to $1,500. And then they received $4,200 more, giving them a balance of $5,700. They're showing a posting of the journal entries here. Identify the debits and credits. Okay. Here is our general journal, a journal entry. When you write this out, when you typed into your computer, cash, 30,000, credit, common stock, 30,000, hit enter, you have not updated the general ledger yet. That's going to sit there waiting for one more step, which is called posting. Once you have written your journal entry, or more likely entries, you will then tell the system to post. And look what happens when you post. The debit to cash that you've identified in the journal entry shows up as a debit in the general ledger as we want. Credit to common stock, credit to common stock, okay? Analyze the impact of transactions. Processing transaction, double entry accounting is useful in analyzing, huh? Analysis of each transaction. Identify the transaction in any source documents. Again, if you were doing a payroll, it might be the time cards. It might be a printed summary of the payroll by department. It could be just the electric bill. It could be complicated. It could be very simple. Identify the transaction and analyze it using the accounting equation. Record it in the general journal via a journal entry, and then post. And keep in mind, for simplicity, T accounts represent ledger accounts, okay? Processing, we'll go through some transactions now, like we did in the first class, only the way you're actually be doing them in the real world. Fast Forward Company receives 30,000 cash from Chaz Taylor in exchange for stock. So we write the journal entry. We debit cash because cash is going up. We credit common stock because common stock is going up. And then once we've done that, we hit post, and there is our general ledger, debiting cash, crediting common stock. You cannot change the general ledger. Once you post to the general ledger, that information, that number, is seared there forever. If you make a mistake, the only recourse is to write a reversing transaction to get you back to the beginning and then put it in correctly. There's no crossing off or erasing or whiteout or anything like that. What supplies, huh? Well, let's put it into our accounting equation. Assets equals liabilities plus equity. Well, he bought supplies. So that's an increase in that particular asset. And it's a decrease in another asset. It's just an exchange of assets. They went out, they recorded the 2,500, credited cash, hit the post button, and there we go. Debit to supplies, credit to cash. Our third transaction, they bought equipment. Again, if we put it into the equation form, equipment's going up, cash is going down. We write the journal entry and post. We bought supplies on credit. On credit. When you see the word credit in a transaction, it means there's no cash involved. No cash involved. The seller agreed to sell it to us with the agreement on our side, we're going to pay him in 30 days, perhaps. So let's see what happened here. We put this into the equation. Supplies go up with a debit, as all assets do. Payables go up with a credit, as all payables do. And then we post, and here we go. We had $2,500 worth of supplies that we bought in transaction 2, and now we have another $7,100. Fast Forward provides consulting services for cash. Okay, let's put it into our equation. Cash goes up, and so does revenue. Revenue increases equity. Expenses decrease equity. No exceptions. Revenue increases equity. Expenses decrease equity. So here's the posting. Debit cash. Cash goes up with the debit. Consulting revenue goes up with the credit. Fast Forward pays the rent. Okay, we had to pay the landlord today. Well, cash is going to go down, but now we've incurred our first expense, and that's going to decrease equity. So expenses go up with a debit. We debit rent expense. We credit cash to reduce cash and go through the posting to the general ledger. Same thing with employee salaries. We had to pay the salaries, just like we paid the Rent. Salaries, expenses debited for 700. Cash is credited for 700, and then the posting. And we want to get into the language of the lingo of saying cash was credited or cash was debited. We don't want to say cash went up, cash went down, cash increased, cash decreased. Let's understand the rules of accounting. Debit, credit. Get into that world. And like I say, this is one of the trickier things in the class as we get started. Those of you who took 110, hopefully this is second nature to you. Processing number 8. We provided two kinds of services, didn't we? We had some consulting work we did, and we rented out some facilities for $300. So let's see here. We did it on credit. You see the word credit, it means no cash. No cash. So we're going to increase not cash, but accounts receivable, which represents the amount of money this customer now owes us. So we're going to debit accounts receivable and credit the two revenue accounts to increase the revenue. Okay, the guy paid us. Hey, that's nice. The guy paid us a couple days later. Well, we got the cash. Cash goes up with the debit. That asset has now increased. But our other asset, accounts receivable, is now back down to zero because we reduced accounts receivable by getting that payment. We made a partial payment to one of our supply vendors, We paid $900 cash toward the transaction 4. Okay. Transaction 4, we bought $7,100. We bought $7,100 worth of goods, and now we're making a partial payment. We debit accounts payable to reduce payables. We credit cash to reduce cash. Okay. Processing transaction number 11. Hey, company paid a dividend. You know what a dividend does, though? It reduces your equity. Dividend is not an expense. A dividend is a cash payment given out to people who own the stock. It could be in the form of cash or additional shares of some kind. When that happens, you debit dividends, which is part of equity. Thus, you are reducing equity with the debit and reducing cash with the credit. Now, here's something you haven't seen before. We'll go over this. You'll get a lot of work on this one. Receipt of cash for future services. Fast Forward receives $3,000 in advance of providing consulting services to a customer. Okay. Accepting the $3,000 in cash obligates Fast Forward to do something in the future. Thus, it's a liability, believe it or not. No revenue can be earned until the services are provided. This could be a lawyer. You walked into the lawyer and you said, I need you to write up my will. And the lawyer said, I need $3,000 just to get started. Well, we're going to debit cash for $3,000, and we're crediting an account called unearned revenue. Unearned, in this case, consulting revenue. Unearned revenue is a liability. Fast Forward does not owe money, it owes the service. And only when they render the service can they claim it as actual income on their income statement. Hey, we bought an insurance policy. Whenever you buy insurance or supplies, it's considered an asset at that moment. The reason is you don't get the benefit of it until the future. So let's look at this. Fast Forward paid $2,400 for a 24-month insurance policy with coverage beginning December 1st. I assume that's next month. So cash, of course, goes down with the credit. The asset prepaid insurance goes up with the debit. Changes the composition of assets from cash to prepaid, and expenses incurred only as the insurance expires. So that's a 24-month policy. They're going to be expensing that off at $100 a month for the next 2 years. Same thing with supplies. They bought $120 worth of supplies. Well, those supplies are an expense right now because you haven't used them. You just bought them. But when you use them, then you'll record supplies expense. Utility expense, here we go. They're paying their electric bill, huh? $305. Debit utilities expense, credit cash. And you see that cash account's going up and down, up and down. Paying the salaries. Expenses go up with a debit. Cash goes down with a credit. You just have to have that in your mind, however best you can do it. And now we're summarizing things, okay? Here is our general ledger, our complete general ledger. Each one of these is an account in the general ledger. So your balance in cash is 4,275. We were paid off all of the accounts receivable, so we have nothing. We have a certain amount of supplies, insurance, and equipment. We have a debt of 6,200, and we have the unearned revenue liability. And these are the various equity accounts we hit. We hit the common stock when when the public bought our shares. We recorded the dividend that reduces equity. The consulting revenue is a credit, thus increases equity. So does the rental revenue. And all your expenses have a debit balance. And it looks like we're in balance here. 42,395 assets equals 9,200 plus 33195. From this, let's assume this was the entire month of a particular company. Now we've got what we need to start preparing the financial statements. And we're going to do it with the starting help of a trial balance. A trial balance. What's a trial balance? Trial balance is 3 steps. You simply list each account title and its amount. If the account has a 0 balance, you typically omit it. Okay? You just list each account that has a balance in the proper order. You add up the debits and credits and make sure they equal, as they should. That's all the trial balance really does for us. It's just a proof that debits equal credits. Here's the trial balance. I see 4,275 for cash, 9,720 for supplies. 4,275 for cash, 9,720 for supplies, 2,400, 26,000. You get the idea. There's our trial balance. The trial balance lists all ledger accounts and their balances at a point in time. If things are in balance, the debits will equal the credits. Now, in the year 2023, I seriously doubt it's possible to run an unbalanced trial balance. You're working with computer system pretty much exclusively. Back in the old days, going back as far as the 60s, I'm an old guy. This was all done in pencil, and it was easy to screw up. So the trial balance had a lot more import in those days because it was your only chance to get things right at the end of the month. What if you're looking for errors? If the trial balance doesn't balance, the errors have to be found. And you check the adding, you can look at each account, make sure they're correctly, you do your due diligence. See if debit or credit accounts are mistakenly placed on the trial balance. You just go back and try to find your error. Now we're ready to prepare the financial statements, huh? We're going to prepare an income statement and a balance sheet and a statement of retained earnings. Let me start again. We're going to do an income statement, a statement of retained earnings, a balance sheet, and statement of cash flows. Notice that the income statement and the statement of equity represent a period of time. It's not a snapshot looking at what's there today. What it's showing you is the accumulation. We had sales on Monday, Tuesday, Wednesday, all month, and those sales now equal this. So your income statement and your statement of retained earnings is kind of like a video. It changes, it goes up every day, it goes up to the next screen. The balance sheet is a point in time. It's just a snapshot of how much you have of your assets, liabilities, and equity. And that's an important point to make when labeling the statement. The 4 financial statements, what do they do for us? Income statement reports your sales, revenues, less expenses incurred by a business over a period of time. That's all the income statement is. Your revenues listed, totaled up, and then your expenses listed, totaled up. Subtract them, and there's your net income, your income for the period. The income statement will get bigger and bigger as we get into more complicated areas. But right now, it's basically the same thing, revenues minus expenses. Once we do the income statement first, and you have to do the income statement first, there's no questioning that. You have to do the income statement first because we need to get that net income number and bring it over to the second statement, the statement of retained earnings. Here, we're going to start with the beginning balance of retained earnings. We're going to add the income to that number, subtract any dividends, and we come up with the new equity number. Having done that, we can now prepare the balance sheet. And all we're going to do is copy everything over from the trial balance except for the new equity number. And then we do cash flows, and we have a whole chapter on the cash flow statement coming up in a month. So let's look at your income statement, huh? Income statement. They had consulting revenue, they had rental revenue, and they itemized them, $6,100. Salaries expense, rent, utilities, total expenses, huh? $2,705. Your net income, $3,395. Now that we know what the net income is, and only when we know that, we can go to the statement of equity. Okay? So look at our statement of equity here. Remember what we said? It's the beginning balance, which in this case is 0. It was a new company. Beginning balance 0 plus net income $3,395 minus 200 equals your new equity balance in the form of retained earnings. Okay. I think this is the first time we're using retained earnings in terms of equity. Retained earnings is a part of equity. It represents the net income from the first day of business till 50 years later, net income. We made $100 year one, retained earnings now 100. We made 900 the next year, it's now 1,000. And that goes up and up and up. It captures the earnings. It also captures the dividends, which reduce your equity. So there's our retained earnings statement. Look at the balance sheet. 4275, 9720. Every one of these numbers was copied from the trial balance, except one. What is the one number that changed? The answer is your equity number. Equity was 3195. At the beginning, it was 30 because you only had 30,000 in the equity from the stock issue. And now you're up to 33,195. Everything's in balance. Some presentation issues I don't think are much import. You don't use dollar signs in the ledger, in the journals and ledgers. You'll understand that intuitively. When you're preparing the statements, you can put a dollar sign at the beginning and the end. When amounts are entered in the journal, commas are optional. Commas are always used in financial statements. Not to worry about that. And let's end up with one more metric. The debt ratio. Ta-da! The debt ratio, called the debt to asset ratio. Total liabilities divided by total assets. A higher ratio indicates there's a greater probability that a company will not be able to pay its debt in the future. It evaluates the level of debt risk. So you like this number to be as low as possible without going super low for different reasons. So here we go. Total liabilities, total assets for Costco and Walmart. So we see Costco had $25 million, I guess, in liabilities. That could be billions, actually, but anyway. The debt ratio is 0.7, okay? It means, I want to say that as simply as possible. It means they have 70 cents of debt for every dollar of assets, okay? So that constricts the spending to those numbers. They have 70 cents left over for every dollar of asset. And looking at the debt ratio for Costco, it went down 4, but then they had a pretty good jump the current year. I don't know why it jumped. They might have gone out and done some investing, spent some money on equipment or something. Might have to do with the pandemic and how their product is selling. Walmart is staggeringly consistent, 0.58, 0.58, 0.59. Debt ratio. Get familiar with these different metrics that pop up each chapter, because the second FSA is merely doing all of these transactions for a specific pair of companies I'll choose. And that's it. That's it. Any questions, anybody? Brendan?
Just to go over, the 0.70% debt ratio means that every dollar of asset they have 0.70 cents left over after they what?
They have 70 cents of debt.
Oh, they have 70 cents of debt. Okay.
They have 30 cents left over. Yeah, good question. What do you think, Grant? You're okay?
Yeah, I'm okay. Thank
All
you.
right. Maria, anything you want to tell us?
No, thank you.
Okay, you don't want to redo the whole chapter for us then, huh?
No, I'd prefer not.
Okay, thanks for hanging in there with me, and I guess we'll see you Monday, huh?
Yep.
Hey, you take care now.
Thank you. Have a good day.